In this video, I'm gonna answer whether or not you should become a blue chip stock millionaire. True or false? I got this question from YouTube from a comment. Why should you just invest in real estate? Can you prove that it makes sense to do what you're saying from an investment strategy as opposed to the blue chip stock dividend strategy, which is a good strategy. It's really good. A lot of people have made some good money doing that, and I've done that from time to time. But in this video, I'm gonna tell you exactly why that's maybe not the best thing. I'm John from BulldogMindset.com. On this channel, I teach you how to be a man. I teach you how to build financial independence, how to get the physique you want, how to get the girls you want, and how to go from the victim mindset to the bulldog mindset. If that's something that you are about, you should already click that subscribe button. But if you haven't, I'll give you a second. Just go ahead and do it anyway. I have made more than $1 million more than once in multiple areas. Okay, I've made over $1 million in real estate. I've made over $1 million in business, in multiple businesses. I've made it in royalties and in books. Yakata, I kind of like that name. He says, wouldn't it be wise to invest some of the money in blue chip stocks instead of focusing on one asset class? Can you mathematically prove it doesn't make sense? Great content, by the way. There's a reason why I do this, all right, mathematically, and it's based on the returns. When I talk about real estate investing, this is the very, very basics. Let's say that you buy a property for $100,000. You put 20% down on it, so $20,000. It appreciates in 1 year 3%. The average appreciation since like 1950, something like that, is 3.7%. The property value in 1 year, if you had a 3% appreciation, the value of the property is now worth $103,000. Okay, so the gain on the property, or your net gain, right, at this point, is $3,000. If you had invested $100,000 of your own money into the property, your return would be 3% of the appreciation, and you get more cash flow on it. So it'd probably be like, you know, it'd bump up. You didn't invest $100,000 of your own money. You put $20,000 of your own, and the bank put $80,000, and then the renters paid the mortgage, essentially, whatever the bank's, what it cost you to borrow that money, and so you broke even on that. And so on your $20,000 investment, you made $3,000, okay, which is 15%. You invested $20,000, and your return, your total money at the end of 1 year value is $23,000. I know I've simplified things greatly. I know I've ignored transaction costs and all of these things, okay, but I'm not advocating investing in real estate for 1 year. Okay, I'm advocating doing this, holding a property for 10, 15, 20, maybe even 30 years, where these other things will sort of balance out. At its very face value, the minimum that I usually say that you're going to make on a real estate investment, on average, the minimum is 15%. And not only is it 15%, but see, it's actually better than that because of the other things I ignored, the depreciation, the cash flow, the principal pay down. Okay, those are significant over time. And it's tax-free because you can defer the taxes forever by one of two methods. One, doing a 1031 exchange, which I've done a lot of them. I just sold like 6 properties and moved them into one big property, okay? And I don't pay any taxes on all that gain I made, all right? Or two, by doing a cash out refinance where you take the money, the equity out of the property. You can essentially grow your real estate and get the profit without paying any taxes on it. Wouldn't it be wise to invest some of the money in blue chip stocks instead of focusing on one asset class? With stocks and bonds and some of these other things, or let's say Forex, Bitcoin even, you have no control over that. When you buy a property, a real estate property, you have full control over it. Now, there's a few factors that are outside of your control, things like interest rate, but if you got a fixed mortgage, which I always recommend, then you've nailed that one down. The value of the market can go up and down. So your property value could go up and down, which if you're holding for the long term, it doesn't even matter. So you can kind of nail that one down. I bought properties in 2007, 2008, boom, cut in half. But now we're at 2020, and guess what? They've doubled since their high point, okay? So it came back. It didn't matter because I had 30-year fixed mortgages on some of those properties. So there's some variables, right? Maybe the rent, power, or you know, there's maybe natural disasters, some things that are outside your control. You can mitigate and hedge against some of those things with insurance and things like that, and liability by having LLCs to hold your property. There's a lot of things you can do to kind of insulate yourself from that. But for the most part, you have control. You can fix up the property. You can control how much you rent it for. You can control what you buy, where it's at, right? All of these things, you have a lot more control. Who's managing the property, how it's being managed, right? All of these things, whether you offer rent incentives, whether you upgrade the property, whether you redo the bathrooms, all of these things are within your control. So you're really controlling that asset and that investment. So you're reducing the risk. You're not relying on someone else. You're relying really on yourself. And you're also starting with with an investment that has a baked in profit that is very, very high. Some of you guys are like, well, John, yeah, it's survivorship bias. So you're just saying that because you made money in real estate because you invested at the right time. No, I bought my first house when I was 19. Okay, I didn't know jack shit. That was the year 2000 or no, it was 1999. It's 2020 right now. Okay, I've been in real estate. I've been through this. How many years is that now? I'm getting fucking old. What the fuck? 20 years. Okay, been through cycles in the market. All right, now I don't have as much experience as someone who's been investing for 50 years, but I've been in the up and I've been in the down and I've been in the recovery. This has worked out. Okay, that I've never lost my ass on a property. I've always made money. And there have been times where things have dipped down, but because my investment strategy was to hold on to the property with 30-year fixed loans, it didn't matter. When 2008 hit, it actually helped me because the rents went up and I refinanced all my properties because the interest rates on the mortgages went down and I actually ended up making more cash flow even though the values of the properties had temporarily decreased. It didn't matter. You could take some money and you could put it into blue chip stocks. Basically 7 to 8% return before taxes. I think that's okay. That's a decent return. Go and run a compound interest calculator and see what the difference is between a 7 to 8% return before taxes and just use the base real estate return of 15%, okay, with no taxes, after taxes, and see what happens over 20 years or 25 years. And see if you want to take a 7 or 8% return instead of a 15 to 20% return. See if you want to. You need to actually calculate, and I get them to use a compound interest calculator, and I say, hey, look, when do you think you're going to retire? When do you think you're going to be rich? How much money are you going to need to retire, right? You want to retire young while you still have money, right? Millionaire fast lane style, MJ DeMarco. Okay, and I have them actually calculate the number. And if you do this, I think you're going to find that a 7 to 8% return is not acceptable. It is not going to get you there. Even a 10% return is very, very questionable. It's not going to get you there. You need higher returns or you need more time. If you want to boost it, then you need to sell covered calls. If you do that, if you add that to it, now you're talking like maybe 9 to 10% return, which is pretty decent. That I can stomach. It's okay. I don't like that you're still gonna have to pay taxes on it. I think real estate is a much better choice because a lot of the real estate investments I do, I make 20, 25, 30% per year on my investment, which is just like, you can't touch that. I'm either taking the money and I'm putting it in Wealthfront and sitting there until I'm ready to do a real estate deal. And those are the two places because Wealthfront is brainless fucking easy. I don't have to think about it at all. It's automatically handing all this shit to me and I'm sacrificing a couple percent maybe there. And real estate it takes the most effort, but it has the highest fucking return possible, right? And that's what I want to do. I want to get leverage, right? The only way to become rich, okay? You can quote me on this. The only way to become rich is through leverage. Why? Because if you're not leveraged, then it means that the only money you can make is your own money. Is the money that your value that you create from your labor. Okay? That's not enough to become rich. That's it. How can you argue with that? That's why I started getting invested in real estate when I was 19, or a little bit later on. I kind of figured it out, but that's why, because I figured out where all the wealth comes from, and it comes from real estate. It comes from land ownership. That's it, property. All right, guys, that's it. I'll talk to you next time. Take care.